Hey guys, thank you for your interest in making yourself a better investor. Investing has the potential to generate excitement. Observing the daily upward movement of numbers or making unconventional investment decisions that others overlook can be incredibly enticing. It is widely recognized that investing entails assuming higher risks with the expectation that the returns will correspond accordingly. Many individuals invest in growth stocks with exceptionally high price-to-earnings (PE) ratios, hoping that these stocks will eventually justify their valuations or become the next big success, like Tesla, or dare we mention Nikola. Some even venture into investing in the so-called next Bitcoin, seeking to replicate the incredible success of Dogecoin millionaires. On the contrary, the most effective long-term investment strategies are often the least thrilling. Surprisingly, the best-performing stock in the United States over the past 5 decades was not the commonly recognized giants like Apple, Intel, Tesla, or Google. Instead, it was Altria, a cigarette company. Altria achieved this feat by consistently paying dividends for more than 50 years. In this discussion, let's delve into the long-term performance of high-growth stocks versus value stocks and explore where it would be prudent to allocate your investments if you have a long-term perspective. To begin, it's crucial to comprehend 2 key metrics that aid in evaluating a stock: its behavior in the market and the market's perception of its growth prospects. Understanding beta and PE ratio. In order to evaluate a stock and gain insights into its market behavior and growth prospects, it is important to comprehend 2 key metrics: beta and price-to-earnings (PE) ratio. Beta is a measure of a stock's volatility, indicating its risk compared to the overall market. It can have a negative, positive, or 0 value. A beta value greater than 1 signifies that the stock is more volatile than the market itself. For example, Tesla has a beta of 2.08, indicating it is over 2 times as volatile as the market. PE ratio. The price-to-earnings ratio relates a company's share price to its earnings per share. A high PE ratio can imply that the stock is overvalued, meaning its price is significantly higher than the company's earnings. Alternatively, it may suggest that investors anticipate high future growth rates, expecting the company to grow into its valuation rapidly. As an example, Tesla has a PE ratio of 201, compared to the overall PE ratio of 22 for the S&P 500. Generally, stocks with high beta and PE values are considered riskier, as they tend to be more volatile than the market. Growth stocks like Tesla often exhibit high beta, 2.08, and high PE ratios, 201, while value stocks like Johnson & Johnson typically have a lower beta, 0.72, and PE ratio, 18. Value growth. The question of whether it is better to invest in growth stocks like Tesla or value stocks like Johnson & Johnson for long-term investment is a significant one. Research has shed light on this matter with some interesting findings. The outperformance of value stocks was initially discovered in 1985 in a paper titled "Persuasive Evidence of Market Inefficiency." The authors argued that value stocks consistently delivered higher risk-adjusted returns than what would be expected in an efficient market. In a more recent study, it was shown that over a rolling 10-year period in the US from 1926 to 2018, value stocks outperformed growth stocks 84% of the time. This statistic is quite remarkable and suggests that value stocks have an equal likelihood of outperforming growth stocks as the market has of beating 1-month treasury bills. These findings highlight the potential benefits of investing in value stocks over the long term. However, it is important to note that investment decisions should not be based solely on historical performance. Each investor's financial goals, risk tolerance, and investment strategy should be taken into consideration when determining whether to invest in growth stocks or value stocks. Consulting with a financial advisor can provide personalized guidance based on individual circumstances. Indeed, the phenomenon of value stocks outperforming growth stocks is not limited to the US market alone. A study that covered 33 different markets from 1990 to 2011 revealed a similar pattern. It showcased that low-risk stocks, which are often associated with value investing, tend to outperform the overall market. Additionally, considering the concept of beta that we discussed earlier, High beta stocks are generally associated with growth and higher expected returns in the future. However, research conducted by Harvard has consistently shown that low beta stocks have consistently outperformed riskier stocks in the overall market. This suggests that a focus on lower volatility and less risky investments can potentially lead to better long-term performance. These findings highlight the importance of considering risk factors such as beta and the potential benefits of investing in low-risk or value-oriented stocks across various markets. As always, it's crucial for investors to conduct thorough research and consider their individual investment goals and risk tolerance before making any investment decisions. Why boring wins? Boring investments often outperform their more exciting counterparts due to a combination of fundamental and behavioral reasons. Here's why boring investments tend to win. 1. Overvaluation. Exciting stocks that dominate headlines often attract overvaluation. Investors seeking the next big success story may be willing to overpay for companies with similar characteristics, hoping for substantial gains. This can lead to inflated stock prices that are disconnected from the company's actual value. 2. Avoidance of boring companies. Retail investors and even some active fund managers tend to overlook boring companies, which can suppress their stock prices. Many investors prefer to chase after trending stocks to demonstrate participation in high-profile investments. This behavioral bias can result in below-market performance for funds that prioritize safer, more stable stocks. 3. Pressure on professional money managers. Professional money managers often face pressure to include high-volatility stocks in their portfolios to satisfy shareholders' expectations. These managers may feel compelled to dress up their portfolios with market-leading stocks, even if they come with higher risks. This pressure can skew their investment decisions and neglect the benefits of more conservative options. 4. Lottery mentality. The allure of owning stocks with extraordinary gains like Tesla can create a feedback loop where investors flock to these stocks regardless of their current valuation. This lottery mentality leads to overpaying for stocks in hopes of achieving substantial returns. However, the majority of investors end up losing money, similar to the odds of winning a lottery. In contrast, boring investments offer more grounded valuations, stability, and lower risks. By avoiding overvaluation, focusing on fundamental value, and maintaining a long-term perspective, investors can benefit from consistent returns and reduced exposure to speculative market behavior. It's important to note that these behavioral biases and market dynamics can affect investment outcomes, but they are not guarantees. Each investment decision should be carefully evaluated based on individual circumstances, risk tolerance, and thorough analysis. Diversification and a balanced approach to investing can help navigate these factors effectively. You're correct in noting that anomalies in financial markets, such as the outperformance of value stocks, can diminish or decline once they are widely recognized and published. It is known as the efficiency effect, or the disappearing anomaly phenomenon. As more investors become aware of these anomalies, they may adjust their investment strategies, leading to a reduction in the anomaly's effectiveness. In the case of the US market, there has been a decline in the outperformance of value stocks in recent years. However, it's worth noting that value stocks are still outperforming the market by 1.2% annually, according to the latest reports. This suggests that while the magnitude of the outperformance may have diminished, there is still a persistent trend favoring value stocks in the US market. Interestingly, the outperformance of value stocks appears to be more pronounced in the Asia-Pacific and emerging markets. These markets may exhibit different dynamics and characteristics that contribute to the continued success of value investing strategies. Investors should consider regional variations and market conditions when formulating their investment strategies. It's important to recognize that market trends and performance can change over time, and past performance does not guarantee future results. Therefore, it's crucial to conduct thorough research, consider a diversified portfolio, and stay updated on market conditions when making investment decisions. Yes, the idea that boring or value-oriented investing strategies can yield favorable results over the long run is supported by historical evidence and research. While it may be tempting to chase after hot and trending stocks or the next big thing, these investments often come with higher risk and uncertainty. On the other hand, value stocks, which are typically more stable and less glamorous, have shown a tendency to outperform growth stocks and the overall market over extended periods. By focusing on value stocks, investors can potentially benefit from factors such as lower valuations, consistent dividends, and lower volatility. These factors can contribute to more stable returns and long-term growth. However, it's important to note that investing always carries some level of risk, and past performance is not a guarantee of future results. Ultimately, successful investing requires a balanced approach that aligns with an individual's financial goals, risk tolerance, and time horizon. It's wise to consider diversification, conduct thorough research, and seek professional advice when constructing an investment portfolio. Finally, do not ever forget that health is wealth.